Yeah, good afternoon to all of you, those who are listening this particular class. And thank you very much. At least we are reaching to the fifth class during this particular financial services subject. Almost all in the previous four sessions, which are scheduled previously, we have discussed more about the various types of financial services, financial intermediary, fund-based financial services, fee-based financial services, and so on and so forth. These are all covered in the units, previous units, right from first unit onwards. If those who are following well right from the beginning, they can easily cope up with this, and at the same time, so block 1, block 2, block 3 is covered. And in the block 1, financial services and all about. In the block 2, and venture capital. In the block 3, yesterday we have put our efforts to learn about the factoring and factorizing, forfeiting, and securitization of the debt. These are the very recent aspects what we have studied in the previous sessions. Then, when we come to the point to learn about the other aspects in this, then let us proceed with that. Before proceeding to the other important aspects, in the yesterday's class, we have discussed more about the factoring aspects. Factoring is basically a phenomena or a proposed process of giving out or buying out the various debtors of the book debts of the seller who sells the goods on credit, and the responsibility to recover the debts is taken care of by the factorer, and factorer in turn take the responsibility and at the same time the factoring process is also increases the sales of the person who is offering the goods for sale. In this process, the factorer mainly take up the responsibility to be in simplified manner. What is the meaning of factoring? We have discussed in the previous class. And with that, factoring is a process of undertaking the recovery of the book debts, whatever is generated by the seller. Then second aspect in that, we have discussed about the forfeiting. What is the meaning of forfeiting? Forfeiting basically talking about surrendering of the right. Surrendering of the right. So that means forfeit, forfeiture. We have heard this word in the share forfeiture account and so on. In this process, we have understood about that. Forfeit means surrendering of the right. In this process of forfeiting, normally the person who is exporting the goods to the foreign country, then the process of recovering that money from the person who is accepting the import, that bill will be surrendered to the forfeiter, and at the same time forfeiter, and he will be able to recover that particular money on that from the supplier, from the buyer. So this is the process of forfeiting. Basically talks about the cross-border mechanism actually. Then about the securitization of the debt. Then in case of securitization of the debt, so normally so many assets are in the form of fixed assets, etc. Then claims, which are mostly in the form of fixed nature, and the securitization of the debts, they are coming under the process of now coming to the securitization of the debt. It is nothing but to be frank, illiquid assets, which are the assets which are not in the liquid state, they are converted to the liquid state, that is said to be the cash. In this process of that, what we have to understand is that when a debt is said to be liquid, then in such a case, it is easy to recover and so on and so forth. Then, when we talk about these aspects, we can understand clearly when we are talking about this process now, then securitization of the debt. So illiterate or illiquid debts will be considered as a converted to the various cash aspects. These are the various important elements that normally considered in case of the block number 3. Then coming to the block number 4, just follow the what I am typing on the message box, on the chat box. You will be able to clearly note it down on that. So in the case of the chat box open, and then in the case of the investment trusts and mutual funds, that is block 4, we are dealing with that now. Block 4, investment trusts, investment trust. So in this block 4, we are basically talking about the various aspects relating to how the trusts will come into play. And these are actually financial intermediary. We call it as these are investment trust, mutual funds. These are mechanisms which are used for the purpose of providing the various finances to the individual people. Investment trust. So when we are talking about the investment trust, what is the meaning of the investment trusts? Investment trust basically it is called as basically a individual which is an intermediary which pulls up the various resources from the people, and they will invest. The investors, corporates, etc., they will get help from this process of investment trusts. So to be understood about this one, this is actually a close-funded mechanism. So investment trust is a pool of the resources. They will pool up the resources from the individual investors, corporates, and investments. And they will diversify in the form of portfolio, in the form of stocks, 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 bonds, debentures, etc. Actually, stock, you know very well, the stock is a group of shares which are bundled, put together. So what is the main important of this investment trusts? Let us understand, and then we proceed. Investment trust, actually we know mutual funds. That will come under the next topic. Investment trust is one in organizational establishment which pulls up the resources or funds from the investors, those who cannot directly put their funds in the various corporate securities directly. And these investment trusts pool up the resources from the various people who are ready to invest in the corporate securities like stocks, bonds, debentures, and so on. They easily access the investors. So investor is the person who will invest his money. So investor is a person who is ready to invest, who is having a surplus money with him. Then this investment is made in the investment trust, and investment trusts will again redeploy the funds for the purpose of increasing the return to the investors. And every person wants to invest the funds with the objective of earning something extra than what he has put in. So these investment trusts will put their investment in the various shares, etc., then debentures or bonds, etc. And whenever these bonds, etc., are invested, these investment trust units are listed in the stock exchange. We know very well that a stock exchange is an organization or a intermediary financial institution which provides a continuous market for the shares and so on. And these stock exchanges, investment trust units are also listed in the stock exchanges, and investors can sell or buy these units from the stock market and liquidate their capital. If stock market operations are not there, we cannot find an investor. We cannot find a person who is ready to buy our shares. So stock market, as you know well, it helps us to for the purpose of providing a continuous market for our financial securities. Then, so we broadly conclude upon investment trust is an institution which is a pool of resources which takes up the funds from the various investors, and they will buy the shares, stocks, debentures, and so on and so forth. And these investment trust units are listed in the stock exchanges, and these units can be traded in the stock exchange. So then how these investment trusts are different from the mutual funds? So actually, you know about various types of mutual funds. When we are talking about the mutual fund, when we are talking about the mutual fund, a mutual fund is an organization which pool up the resources in small amounts, and they will invest in the various securities just like investment trust only. But the unit trust of India, that is the unit the mutual fund units are quite different from the investment trust. How these are different from that? When in the case of investment trust, this is given in the para number 10.1 for your reference. Para 10.1 for your reference. So when if you refer to this para 10.1, you can para 10.1, you can identify the differences. The investment trusts are basically close-ended investments. Issues are in the name of the fixed number of shares, trading, and possible only in the stock exchanges. So the trading is possible only in the stock exchange. Whereas unit trusts, they are actually open-ended funds, and the investment houses issue redemption of units can happen at any time. They meet their investors on their demand. Anytime you can buy the unit trusts, whereas only investment funds are close-ended. When once a particular date is complete, you will not be able to buy the units from the investment trust. The fixed amount of money is available with the investment trust. The fixed amount of money, because when once I invested, I cannot take back my funds for a lock-in period, say for example, 3 years. So till 3 years, these funds are available with the investment funds. But in case of unit trusts, this type of locking period is not be there in that are not possible to maintain a fixed amount of funds. It is always variable. And then third important point is to understand that due to investment trusts they have flexibility, and they do not have any obligation to meet the investors' demand for their shares. There is the possibility to provide, or there is no possibility to provide the dividend at all. So in fund managers will take long-term view regarding the investments made by the investors. But in case of the unit trust, this phenomena is different. So investors' demands are always, they will expect certain dividends, certain number of additional units, and so on and so on. Fund managers need to sell the fund assets at a lower prices whenever there is a demand from more number of investors. Your investment opportunities are suitable only for the short-term nature, and the available funds are also limited. Then fourth point, in that investment trusts can borrow the money on the investments and their ability to refund the capital vary. Investment trusts, they themselves, they on their own behalf, they can borrow the money from the other institutions. Whereas unit trusts have no flexibility on that. Unit trust organizations, they are not supposed to borrow any sort of money on their own name. The last point is investment trust functions in a more volatile basis and volatile manner. So the investment trust units, they are more volatile. That means they are more changing out. Investment trusts prefer to organize in the long run survival aspect. Whereas unit trust, basically they will refer to the operates a suitable procedure for the purpose of safety of funds is more important in case of unit trusts. So these are the broad aspects which are to be identified in case of the unit trusts and investment trusts. Now, we understood that investment of funds, investment trust is a pool of resources which basically uses for the purpose of investment in the stocks, bonds, etc., which are listed in the stock exchange. They are the pool of resources, especially for the long-term purposes and so on. These are quite different from the mutual fund sector. So these are the various differences that we. So now coming to the other aspect of that, any organizations which are there in India regarding the investment trust? Yes, real estate developers. Normally, huge real estate developers, not the simple constructors or the contractors or so. The huge in real estate developers, they normally face a lot of problem for the financial resources. Crores, not crores, thousands of crores. Thousands of crore rupees of deficits they will face. In such a case, they can develop a trust, and on the basis of the trust, they can collect the money from the general public and they can invest in the real estate property and they can so on. So these are permitted for that. So facing several cash crunches in the market, lack of demand, etc. They are permitted to launch an investment trust to get access to the funds and also create a new investment avenue for the institution of high net worth individual. Who is a high net worth individual? Those people who are having millions of rupees or lakhs of rupees, crores of rupees, which are having a net worth of huge value and they are having huge assets on their name. And then they want to invest in the various real estate, but they may not be able to do it directly. Then in such a case, they trusts and they will go on this. Then this development of investment trusts in India is started in the Finance Act